Hello everyone, welcome back to my channel. Today I am going to help you prepare for credit risk modeling jobs. Whether you are applying to banks or consulting firms, I have picked out some of the most commonly asked interview questions, and I'll also share sample answers with you. Not just that, I'll explain why interviewers ask these questions so you know exactly how to answer them with confidence. If this is your first time here, don't forget to hit the subscribe button and turn on the bell icon so you never miss any updates on FRM and risk related career tips. Let's jump right into it. So, the first question is, what is an application scorecard and why is it important? Here, the purpose of the interview is to assess if you understand the core concept and real world application of a scorecard. The interviewer wants to know if you can explain what it does, when it is used, and why it matters in the broader credit risk framework. So, an application scorecard is a statistical model used by financial institutions to assess the creditworthiness of new applicants at the time of loan origination. It predicts the likelihood of a new applicant defaulting within a defined time horizon, commonly 12 months. It's important because it automates credit decisions for faster processing, reduces subjectivity and manual errors, ensures consistent data-driven risk assessment, enables risk-based pricing and policy design. Next question is, how is an application scorecard different from a behavioral scorecard? Here, the purpose is to assess and test your understanding of portfolio segmentation and how models differ across the credit life cycle. They want to see if you know when and why to use different scorecards and how input data changes based on customer stage. So, the application scorecard is used at the time of application to assess new customers with no prior relationship. It uses demographic and application level variables like income, age, employment type, etc. Whereas behavioral scorecard is used for existing customers, assessing their ongoing credit behavior using account level data like payments, payment history, utilization, past due status, etc. This distinction aligns with Basel II or III IRB requirements for differentiating obliger risk across the credit life cycle. Next question is, what is the typical time horizon for an application scorecard and why? Here, the interviewer wants to see if you can understand the prediction window and its importance. The question checks whether you are aware of default timing patterns, regulatory guidance, and product behavior that influence time horizon choices. So, the typical time horizon is 12 months or sometimes up to 18 months as well, aligning with the regulatory guidelines and product life cycle. The reason behind this is that it captures early risk. Most defaults for unsecured related products like credit cards or personal loans occur in the first year. It ensures model remains responsive to macroeconomic or underwriting shifts. Next question is, what is the target variable in an application scorecard and how is it defined? Here, the interview purpose is to check your grasp of the model objective formulation. The interviewer wants to know whether you understand how to define bad behavior clearly and in alignment with business and regulatory standards. So, the target variable is a binary outcome. Typically, 1 means bad, for example, default or 90 plus DPD within 12 months, and 0 means good, that is no default or satisfactory payment behavior. Defining bad requires alignment with product strategy and risk appetite. So, for example, in unsecured lending, 60 plus or 90 plus DPD is a common threshold. Next question is, what are the key assumptions behind building an application scorecard? Here, the interviewer wants to evaluate whether you understand the statistical and business assumptions necessary for robust model building. This also tests how mindful you are of model risk and potential violations that could impact model performance. So, the key assumptions behind building an application scorecard are: the data should be representative of future applicants, meaning stationarity. Past behavior is an indicator of future outcomes. Predictive variables are independent or not multicollinear. Good-bad distribution is sufficient to train a stable model. Model performance remains stable over time unless there are structural shifts. So these assumptions are critical for regulatory validation under Basel and internal model governance. Next question is, what are the regulatory expectations for scorecards under Basel guidelines? So here, the interviewer wants to assess your regulatory awareness and model governance knowledge. They are testing if you can build or validate models that are compliant with Basel IRB, RBI, EBA or internal risk frameworks. So under Basel IRB approach, regulators expect transparent model development with proper documentation, proper definition and justification of default, that is PD modeling, statistical performance measures such as AUC, KS test, calibration test, independent validation and regular monitoring. Model should be approved by internal governance before deployment. Also, RBI and EBA guidelines stress on explainability, fairness, and model governance. Next question is, what are the typical inputs, that is the predictor variables, for an application scorecard? Here the interviewer wants to verify if you understand how to identify and justify input variables. This includes checking if you know what data is typically available at the origination and how to differentiate relevant from non-relevant features. So the common inputs that are being there in the application scorecard are demographics such as age, marital status, education, employment and income such as employment type, income, industry, loan details such as applied loan amount, the purpose of the loan and the tenor, bureau data such as existing obligations, credit inquiries, delinquencies. All these inputs must be available at the time of application, predictive and legally allowed for decision making. Next question is, how do you define default or bad account while building the model? Here the interviewer wants to ensure that whether you are capable of creating a target definition that aligns with risk policy and can impact the quality of predictions. This also checks if you understand default identification under frameworks like IFRS 9 or Basel. So bad is typically defined as 90 plus days past due, 90 plus DPD within the first 12 months post disbursement. Write-offs, settlements or bankruptcy may also be included. In secured lending, default may be linked to loss realization or recovery triggers. Definition must align with product strategy, regulatory default definitions like IFRS 9, Basel and the available data. Next question is, what is the difference between reject inference and sample bias in application scorecards? Here the interviewer wants to evaluate your knowledge of real-world challenge in application modeling. The interviewer wants to know if you can deal with the lack of outcome data for rejected applicants, which is a very critical issue in scorecard development. So reject inference refers to the challenge that we only have outcomes good or bad for approved applicants, not rejected ones. This leads to sample bias as the model is trained only on approved population. Sample bias affects model generalizability. So to handle this, use reject inference techniques like fuzzy augmentation, parceling or reweighting. Ensure performance is monitored carefully post-deployment. Next question is, can an application scorecard be used for risk-based pricing or credit line assignment? Here, the purpose of this question that interviewer asking is to assess your awareness of the broader use cases of scorecards beyond approvals. This shows if you understand how models are integrated with product strategy, pricing and exposure management, making you a more well-rounded candidate. So the question was, can an application scorecard be used for risk-based pricing or credit line assignment? The answer is yes. Increasingly, application scorecards are used beyond simple approval or rejection. Risk-based pricing. Higher risk scores may attract higher interest rates to compensate for credit risk. Credit line assignment. Credit limits can be assigned based on customers' predicted PD. Some institutions also use dual scorecard strategies, one for risk assessment and another for pricing limits. However, this must comply with fair lending, responsible lending, and model use governance policies. So, these were 10 important questions that cover the basic concepts of credit risk along with example answers to help you get started. Just remember, the more you practice, the better you will get. Use these answers as a guide and make sure to adjust them based on your knowledge and experience. If you found this video helpful, please support the channel Risk Modeling Hub by hitting the subscribe button and giving it a thumbs up. Feel free to share this video with anyone who is preparing for credit risk role. And also drop a comment below if you have any questions or if there is any topic you would like me to cover in a future video. Thanks a lot for watching, and I'll catch you in the next video here on Risk Modeling Hub. Until then, keep learning, keep growing, and take care.